So did you see that Mahindra and Mahindra Financial Services just got their debentures allotted? Seems like a big move for them.
Yeah, I did. They've allotted 500 crore rupees worth of debentures. It was announced on February 27th, 2025, after successful bidding on the BSE Bond EBP platform. Pretty significant.
Right. 500 crore rupees is nothing to sneeze at. What exactly are debentures anyway? Are they like just loans they're taking out?
Well, they're a type of debt instrument, unsecured in this case, where they're basically borrowing money from investors and promising to pay it back with interest. These are non-convertible debentures or NCDs. These particular ones are rated, listed, subordinated, and redeemable.
Okay, so like a fancy IOU. And they're listed on the wholesale debt market segment of BSE Limited, right?
Exactly. It's all pretty standard practice for raising capital. They're offering a coupon rate of 8.33% per annum for a 10-year tenor.
8.33%, huh? That sounds decent. So who are these identified investors they're selling them to?
Typically, it's institutional investors like pension funds or insurance companies looking for stable returns. It's a private placement, so it's not open to the general public. Disclaimer, we advise investors to check with certified experts before taking any investment decisions.
Gotcha. Makes sense. So this is just one way they're raising funds, right? It seems like they're constantly juggling different types of debt.
Oh, absolutely. Actually, they also had their credit ratings affirmed by India Ratings and Research Private Limited. That was announced just before the debenture allotment.
Credit ratings? Like a report card for their financial health?
Precisely. It gives investors an idea of how likely they are to repay their debts. A good rating means lower risk, and M&M Financial Services has some pretty solid ratings.
So what kind of ratings are we talking about? Like A, B, C?
They got an IND AAA Stable rating for their long-term issuer rating, bank loans, non-convertible debentures, subordinated debt, and fixed deposits. Their commercial papers got an IND A1 plus rating, all affirmed.
Wow, a clean sweep of FAA ratings. That's pretty impressive. What does stable mean in this context?
It means the rating agency doesn't foresee any major changes in their financial standing in the near future. It's like saying steady as she goes.
Right, so nothing too exciting on the horizon, just smooth sailing. Why are these ratings so important anyway?
Well, for starters, these ratings can influence investor confidence. And hey, if investors trust you, they're more likely to invest in your bonds, debentures, and other financial instruments.
Absolutely. So it's all about building trust and proving you're a safe bet. I guess that explains why they're so keen on publicizing these affirmations.
Exactly. It's a sign of financial strength and stability. It also helps them secure funds at competitive costs.
Competitive costs, meaning lower interest rates on their borrowings?
Yeah. A better credit rating usually translates to better terms when they're borrowing money. It's like having a good credit score, but on a corporate level.
Makes sense. So India Ratings thinks M&M Financial Services is doing a good job managing their finances. But what's driving these positive ratings?
A big part of it is the expected support from their parent company, Mahindra and Mahindra Limited. India Ratings believes M&M will provide timely financial support if needed.
The parent company's safety net. So being a part of a larger, stable group helps boost their credibility.
Definitely. M&M holds a 52.16% stake in MMFSL. So there's a strong connection there. Plus, they share the same brand name and have strong operational links.
Okay, so it's like having a co-signer with a stellar credit history. What else is contributing to their strong ratings?
Well, their diversified funding profile is a big plus. They're not relying on just one source of funds. They have access to banks, capital markets, and even fixed deposits. That kind of mix is always seen as a sign of financial prudence.
Diversification is key, just like in an investment portfolio. What about their asset quality? Is that playing a role too?
Definitely. They've shown improvement in their asset quality recently. They're targeting better customer profiles and the operating environment has improved.
So, less bad debt on their books? Sounds promising.
Precisely. Their stage 3 assets, which are basically loans where payments are significantly overdue, have been stable. And their provisioning coverage is deemed adequate for a secured asset class.
Gotcha. So, they're managing their risk effectively. All these factors combined paint a pretty rosy picture.
Yeah, and their profitability has improved too. Better control over credit costs and a slight improvement in operating efficiency are helping boost their bottom line. It's always good to see a company firing on all cylinders.
Absolutely. It's like a well oiled machine humming along smoothly. Are there any areas where they could improve or any potential weaknesses?
India Ratings did point out that their leverage has increased due to healthy growth in their loan portfolio. It went up to 5.5x in December 2024.
Leverage meaning they're borrowing more relative to their equity?
Exactly. It means they're taking on more debt to finance their growth. While growth is good, too much debt can be risky.
So it's a balancing act, growing the business without overextending themselves. Does India Ratings have any concerns about this?
They believe that the parent company M&M will infuse equity in a timely manner to support growth. The board has actually approved an equity infusion through a rights issue of up to 30 billion rupees.
Okay, so they're aware of the leverage issue and have a plan to address it. That's reassuring. So to sum it up, M&M Financial Services is getting good ratings because of their parent company's support, diversified funding, improving asset quality, and better profitability rate.
You got it. Despite a rise in leverage, they're managing their finances well, and their parent company is expected to provide support if needed. It's all about that balance between growth and financial prudence.
Makes sense. It's good to see them performing well. Oh, by the way, I think this would be a great moment to ask our listeners to like, share, and subscribe to our YouTube channel for more financial insight.
Great idea. And hey, one last thing. It seems the market reacted positively to this news.
Oh, yeah? How so?
Well, M&M Financial stock ended 3.32% higher after the news broke. It even rose as much as 5.4% during the day.
There you go. The market clearly liked what it saw. All right. So, what's next for M&M Financial Services? Are they planning any other big moves?
Well, it'll be interesting to see how they manage their leverage and continue to improve their asset quality, And of course, we'll be keeping an eye on any further developments with their parent company, M&M.
Absolutely. It's a dynamic situation and things can change quickly. So, what are the key takeaways for our listeners from all of this?
Firstly, credit ratings matter. They provide valuable insights into a company's financial health. Secondly, diversification is crucial, whether it's in funding sources or asset classes. And thirdly, parent company support can be a significant factor in a subsidiary's success.
Great points. And remember, folks, always do your own research and consult with financial professionals before making any investment decisions. So, what other companies should we be keeping an eye on?